Hey, what's going on, PFR Nation? This is Kevin Lau, your host of the Planning for Retirement podcast, and welcome to another Whiteboard Fireside Chat. Today, we're going to be talking about solo 401ks at my dining room table. So, as you can tell, I'm working from home today, and I've got a 7-day beard going. So, let's go. Work from home life right now. It is November, so no shave November. But solo 401k is one of the most powerful tools for self-employed individuals that do not have any full-time employees. Spouses do not count. And so if your spouse works in your business, you can still operate under a solo 401k agreement. Once you hire employees, then you're going to have to transition to a different plan. The most popular being a regular 401k plan. But the most popular plan when I started in the industry back in 2008 was the SEP IRA for self-employed individuals. And that's still a very popular tool. The challenge is the lack of flexibility. Once you hire employees, full-time employees, you need to make the same employer contribution for all of your employees, including yourself. So if you are contributing 15% of your income, you need to contribute 15% for every single employee. And that can get expensive. Typically a 401k plan, you might match up to 3%, maybe 5%, maybe 6%, but not 15. So those can get pretty expensive if you're trying to really aggressively save for retirement. And again, once you have employees, you can't operate under the solo 401k. You need to transition over to a regular 401k plan. So I'm going to be talking to those of you that are self-employed without any full-time employees, and or if you're, let's say you are an employee and you have W-2 income from another job that you're not an owner of, but maybe you have a side hustle. Maybe you've got a consulting gig on the side and you're earning some 1099 income. You can set up a solo 401k. For that business, for that entity, and you can potentially do a little double dipping. You contribute to your company's 401k plan as well as your solo 401k. So again, let's jump into this. And if you are planning for retirement, if you are in that 50 to 60 range and you're really aggressively trying to plan for this financial independence, make sure to subscribe to the channel. That way you can follow along on all of our content here. And we've got a really exciting podcast coming out this Thursday. It's called the End of Year Tax Planning Tips for 2024. Just really talking through some of the things that we're looking at with our clients as we prepare for the end of the year in terms of tax planning for 2024 and beyond. All right, without further ado, why don't we jump into the whiteboard? So I already mentioned why I love the solo 401k, just the flexibility in being able to really aggressively contribute and save for retirement. And the thing with the SEP IRA, we'll transition to the solo versus the SEP. The SEP IRA, you must have employment income. Self-employment income in the amount of $345,000 in order to max out the $69,000 total contribution for 2024. Whereas the solo 401k, you don't need to. Okay, now you must have a profit. Okay, in order to contribute to the solo 401k, so you can't have a loss. In order to maximize those contributions into the solo 401k. But assuming you did have some earned income and assuming you were profitable, you can contribute up to 100% of your self-employment income or $69,000, whichever is less. So if you are making $200,000, you can contribute $69,000. If you're making $30,000, you can contribute $30,000. Okay, but in general, what's cool about the solo 401k is that you have multiple sources of contributions here. You've got employee contributions, just like a regular 401k plan, and those deferral amounts. For 2024, the max is $23,000 if you're under 50, and then of course the additional catch-up of $7,500. All right. Then you've got employer contributions that you can contribute, and this is up to 25% of your self-employment income. Okay. And again, I recognize there are a lot of complexities of the solo 401k. Depends on your entity status, if you're a sole proprietorship or an S corp or a C corp. There's a lot of complexities there, so I'm not going to pretend like I'm the expert in all of these rules here. I personally use mysolo401k.net. I'll drop a link in the comment section if you're interested. But they do, I think, weekly webinars. They do a ton of content out there, and they are just experts in this. I think they're actually attorneys that started this business, and they're just phenomenal in terms of a resource for solo 401k. So I'll drop a link there. But this is just my understanding of this, is that the employer contributions, of course, that's going to be very similar to the SEP IRA, because SEP IRA, technically speaking, these are employer contributions only, okay? And so that's going to be up to 25% of your self-employment income. So if your self-employment income, your net self-employment income, let's say is $100,000, you can put a $25,000 employer contribution into the plan. And let's say you're under 50 and you were doing $23,000, Now you've got a total of $48,000 in there. Well, we know that the total contribution limit for these defined contribution plans is $69,000. So technically speaking, you still have room for an additional 21K in order to top off that 69K. So we're going to get into how these work. This would be these after-tax contributions, okay? Or kind of what I like to call a top-off contribution. And we'll talk about how these work and ultimately how you can incorporate these into the plan. But again, your income doesn't need to be $345,000 as a self-employed individual. I mean, your consulting income might be 60, 70 grand. And technically speaking, you can get in the max contribution of the $69,000 into the solo 401k. All right, so contribution sources, we just hit on this one. You've got the employee contributions, okay? You've got your employer contributions, and you've got your additional contributions, your after tax. Okay. So really, with the regular 401k plan and the solo 401k, you've got really kind of the same type of scenario. You can contribute as an employee to your regular 401k, $23,000 plus the $7,500 catch up. And then let's say your employer matches you can get some matching contributions in here. Maybe they're contributing 10K, right? And sometimes the plan, your 401k plan, your regular 401k plan might allow for additional contributions on an after-tax basis, again, up to that $69,000 limit. Solo 401k, same thing. But the cool part is with the solo 401k, you can adopt this into your plan language, okay? You don't need to rely on your employer in your employer 401k to adopt this after-tax contribution. And I think that's really the key here is that, when you're designing your plan, you can put in the plan documents that allows for this after-tax contribution source. And that sort of unlocks the ability to contribute this max contribution source of $69,000 without having $345,000 of self-employed income like you would with the SEP IRA, okay? So that's really the beauty. We just hit on the contribution sources. We're going to go on here, and we're going to talk about this idea of a side hustle and how this communicates to one another. So let's say you have a W-2, let's say you have a full-time job, okay? And let's say that job is paying you, all right, it actually doesn't matter what it's paying you, but let's say you're contributing, the $23,000 plus the $7,500 catch-up contribution. Let's say you're over 50. So you're contributing a total of $30,500. Okay. So let's say on top of this, you have a side hustle, and let's say you earn, let's say you're 1099 or you're a sole proprietorship, and let's say you're making, I don't know, $100,000. Okay, of self-employed income, net self-employment income. Okay, so the question then comes, well, can I do an additional $23,000 as an employee contribution? The answer is technically no. The 401k limits apply across all plans, okay? So they really aggregate these. So this sort of, really goes for those that are working a full-time job somewhere and then they have another job somewhere else that they're also eligible to contribute to a 401k. This is really where this comes into play, where you can't contribute an additional $23,000 to the solo 401k plan. But what you can do is you can contribute into the employer contribution. You can make an employer elective contribution. Okay. And again, the 25% of net self-employment income will come into play here. So you can put in 25% of this number or $25,000. Okay. So if you look at this in aggregate, if you add these two together, now we have a total of about 55.5K, $55,500 that you've contributed. Okay. But we know the max contribution for these 401k plans is $69,000, excluding the catch-up contributions. So technically speaking, what you could then do with this self-employed, with the business, with the solo 401k, is you can then make an after-tax contribution, okay? And that amount could be this $25,000 number netted out of the $69,000. This $23K in this $7,500 catch-up, so this total $30,500 does not count against the total contribution amount that you could make to the solo 401k plan. At least that's my understanding. If you're watching this and you understand this differently, drop a comment and let me know. Maybe point to an IRS, an IRS publication. But the after tax, what you could then do is say, okay, I still have room for a $49,000 catch-up contribution, after tax contribution, or this top off. I'm sorry, what did I say? 49,000? I meant to say 44,000. Okay, so you can make this $44,000 additional contribution. So if you add this $30,500, right, plus the $25,000 profit sharing or employer contribution in the solo, and then this top off of 44, what you're going to get is 69,000 plus the 30,500. So you've contributed a total of $99,500 to this plan. And maybe you even had some matching contributions in your full-time job. Okay, that also doesn't count to this limit. So I mean, technically speaking, you could be contributing in excess of six figures into these plans. Okay, with not really having a ton of self-employed income, which is really, really cool. Now, what happens though to this after-tax contribution? In most cases, if you make an after-tax contribution into a 401k or an IRA, those dollars are going to be growing tax deferred. Okay, so which is fine, but you didn't get any tax deduction for it. So technically speaking, were you better off doing something else? I don't know. Maybe not. Okay, well, this is where this mega after-tax Roth contribution comes into play. So let's say you made this $44,000 after-tax contribution. Okay. But now your plan documents in the solo 401k plan allow for an in-plan Roth conversion. Okay, so many of you are familiar with Roth conversions, especially if you've been following me for a while. Is basically you convert dollars from a tax-deferred vehicle like a tax-deferred IRA, tax-deferred 401k into the Roth version of that. So in this case, let's say you adopted in your adoption agreement, you put in the fact that this allows for this after-tax Roth conversion within the plan to happen. So now what you would do is you would take this $44,000 that you made on an after-tax basis. Sorry, you can hear my boys probably upstairs wrestling around. That was after-tax contribution. And then what you would do is you would then convert that contribution to the Roth 401k. So now you literally just made a $44,000 Roth 401k contribution without doing anything other than just put in some, literally you hit the conversion button and then, you just made sure you had that document in your 401k agreement. And many employer 401ks have this as well. It's not just for the solo 401k. You've heard me probably talk about this mega after-tax Roth contribution in regular 401k plans before. Many regular 401k plans have this. Engineering companies, financial services, law firms, private equity, big tech, of course. So many of these plans are now adopting this mega after tax. So even check your plan, okay? But like I said, now you've got this $44,000 that you can contribute directly into this Roth 401k. And let's say this other, this $25,000 contribution you made into your plan and into your solo 401k via the profit sharing or that employer contribution. Let's say that was also Roth. So let's say that was also Roth. That employer amount was $25K, and that was also Roth. And let's also kind of assume that your full-time job, you're also doing this $30,500 all into Roth as well. Now you've contributed $99,500. And this also includes the 401k with W-2, $30,500. Let's say that was also Roth. Now you could just contribute $99,500 all to a Roth 401k. I mean, you can just, now you sort of see how powerful this tool can be. Now, I'm not saying do that, okay? It might make sense. If you're a highly compensated individual, your tax bracket's fairly high, maybe it makes sense for you to do a tax-deductible 401k plan and then ultimately look at Roth conversions down the road. But ultimately, this is just sort of painting the picture of how powerful these 401k plans could be, and particularly these solo 401k plans. So I hope you all found it helpful. And again, your situation might be, this situation is complicated. Okay, if you have a full-time job, if you've got a business on the side, depends on the entity status. It depends on your contribution sources with your W-2 job, and also how much self-employment income you have within the business. That's going to dictate how much you contribute to these plans. So don't take this as advice. Okay, this is just education to sort of paint the picture on what's potentially available. But hopefully this helps, and consult with your own advisory team to make sure that you are following all the rules. So again, that's it for today, everybody. Real men make twins, and I hope you guys found it helpful. And if you have a question or something along those lines, if you have a comment, drop it in the YouTube, drop it in the comment section. We'd love to answer it. And again, make sure to stay tuned for this Thursday for the podcast coming out, the tax planning tips for 2024. And of course, make sure to subscribe to the channel if you're finding value in the content and you're planning for retirement journey. Until next time, PF4 Nation, this is Kevin Lau signing off.